Hello again, and welcome to another episode of the Uranium Market Minute. Today is Wednesday, December 15th. This is episode 51. My name is Justin Hune. I'm your host, the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you so much for tuning in. Thanks for all the congratulatory and supportive comments on episode 50 yesterday. Really been enjoying doing this channel. I'm really grateful to have this platform to speak about uranium, to speak about investing, and there's always just so much going on, and it feels like it's been a good fit. There's always something to talk about in the uranium market, and when things are slow in the uranium market, it's nice to hopefully add some supportive discussion around investing fundamentals, around the volatility of resource markets, etc. Before we get into today's video, as always, nothing in this video is intended to be investing advice. I'm not your financial advisor. This is not financial advice. Please always do your own due diligence when it comes to investing. Always take responsibility for your own choices. Nice to see a little bit of a bump today in the market. Nice to actually see the color green on the screen after it's been a number of weeks of red. There's actually some decent volumes there. We will show the charts in just a moment. If you do appreciate these videos, please like this video, subscribe to the channel, hit the notification bell, and you will be reminded and notified anytime we publish a new video, which is just about every day. And let's go ahead and jump right into the daily scoreboard here. Spot price of uranium unchanged from yesterday, $43 a pound mid-market. It's very interesting. I actually had a call today with Mr. John Ciampaglia, the CEO of Sprott, and he basically said that it's extremely quiet in the spot market. When they were out of the market, this was in September. I don't know if you remember, after they ran through that first 300 million in about 4 weeks, and they had to re-up their ATM. It was during that moment, and then they traded at a discount to NAV for another moment. Both of those times where Sprott was out of the market, there was a lot of material coming into the market. There was somebody just getting uranium off their books at any price. They weren't even heavily in there, and they were just being offered at a lower and lower price, right? And what we're hearing now is it's dead quiet in the spot market. We saw a little bit of material move a couple of days ago. We saw the price tick down about $1.50, but relative to them being out of the market prior, nothing's happening here. And that's really an interesting sign to see this new substantial buyer in the spot market that has emerged this year being out of the market and the price stabilizing. So that's kind of something that we took note of, and that he took note of, and definitely made a point of mentioning. So that's kind of curious. Like I mentioned a couple videos ago, I wouldn't be surprised if we see it move down a little bit more towards the end of the month, if we don't see some buying come back in during the month from Sprott. And honestly, I'm not holding my breath on that. It's just become a quiet moment in the markets. There's, broad market jitters and concerns about inflation, concerns about COVID, etc. It doesn't feel crashy to me, but it does feel cautious. And so I think that what we're going to do here is we're going to find this bottom, at least for the uranium market, probably chop around. And once we get into that new year, I think we'll be in a new place for an uptrend and a resumption of an uptrend. That's kind of where I'm thinking things are going now. Of course, I don't have a crystal ball, but seeing how quiet it is very interesting in the spot market. Of course, it's not all that concerning due to the time of the year, right? I mean, we're moving towards the holidays. People are largely concerning themselves with other things, with kids getting out of school, careers taking a break, maybe being out of work for a week or two on a vacation, and obviously family during the holidays. So more and more, it's just looking like it's going to be a remaining couple of quiet weeks, but it is nice to see some volume and some buying pressure come into the market today. The Sprott Physical Uranium Trust did not raise any new money yesterday, nor did they purchase any pounds. They closed yesterday at the largest ever discount to their net asset value, minus 0.8%. However, trading up nicely today, currently sitting at just under a 4% discount to NAV, up about 4.5% on the day, with a spot market flat. They still have 30 million in the bank. The numbers have not changed. Obviously, 22.9 million total pounds purchased since August 17th, when their ATM went live, raised just under $1 billion, and they have a total allocation in that ATM of 3.5 billion. They clearly are setting themselves up for another run on the Sprott Physical Uranium Trust out into the future without having to dip back in and re-up that ATM more frequently. They're set up now where they can run another Let's see, they just under $1 billion. So yeah, another $2.5 billion before they need to re-up. That's a lot of money for buying physical uranium. Turning to the sector equity ETFs, URA reported no redemptions. URNM reported a decrease of 150,000 in outstanding shares. That led to an outflow, mandated selling of about $11 million yesterday. Sector continues to be very weak, with an exception of today. Leading into yesterday, the close was definitely weak, despite the fact there's not been large-scale redemptions from these two large sector ETFs. What do I mean by that? So this flywheel effect we've talked about a million times. Essentially, money flows in and out of these ETFs. When the money flows in, ETFs are issuing new shares and buying their underlying holdings. And the opposite is true when the sector, when there's outflows. However, the outflows from the ETFs have been very minimal on this pullback. And what that really shows to me is that this pullback, in my opinion, has been largely, it's been largely fueled by retail, and it's been largely fueled by potentially, institutions if they're reducing size, or if they're booking gains. There's a lot of gains. A lot of institutions booked, unrealized gains year to date from the beginning of the year that may have positioned December of last year, January of this year, February of this year, and are still up big despite this pullback. So in my opinion, there's been probably a little bit of gain booking by people that manage money, and a lot of panicked retail kind of selling on the way down. So we haven't seen remarkable volumes, but they haven't been nothing, right? But the ETFs have had very little redemptions in terms of shares. So a lot of this selling that we're seeing in individual equities has not necessarily been coming from the ETFs. Very curious. Going back to the ETFs, the combined AUM declined again yesterday by a further 75 million. Has everything to do with just with the price action of those two ETFs. This pullback, 600 million lower than the high point in mid-November. That's not substantial. About a 25% drop off in AUM for the ETFs since the November highs. That's something that's definitely notable. Let's take a look at the charts and see how things are looking for the day, which look to be a little bit improved. Starting out with URA, as always, the largest and most liquid ETF in the uranium space. URNM chart is usually pretty similar, although it tends to outperform URA. It has outperformed URA this year. But URA, nice reversal today. Pretty solid candle, up almost 3% on the day. Decent volume. We still have an hour left in the day, in the trading day, and decent volume here. This is not huge, massive breakout volume, but it is nice to see these last 2 days printing green candles on slightly increasing volume. I'm not being a cheerleader here necessarily or about to celebrate this, but it is nice to see this absolute perfect kiss of the 200-day moving average. I mean, it just touched it today, rebounded immediately. I would love to see that hold. Will it hold? I don't know. I would like to see it hold. What we saw back in August was this undercut low. What that means is a lot of people that put stop losses in the market that are trading technically will say, okay, if this closes on a daily close below the 200-day moving average, I'm out. What that does is ends up triggering those stop losses, and you'll have a couple of days where it'll break down below that classic level of support and people will reposition. And so will we see that? It's possible. This does look like kind of a reversal candle here. It's nice to see it touch on the bottom there. Nice to see volume improving. Nice to see the technicals kind of perk up a little bit. RSI kind of the indicators perking up a little. MACD just, not really reversing very hard here, but at least picking its head up off the floor. Sprott Physical Uranium Trust, very strong, up almost 5% on the day. Where is my volume here? Sorry, this is lagging for a second. There we go. Yeah, nice candle on the day for the Sprott Physical Uranium Trust. Volume's not huge. This is probably retail buying that dip, taking advantage of that huge discount to NAV. Doesn't really look like this is institutional money piling back in. So will this be a continued strong trend here? Probably not. Is it a positive sign to see that dip yesterday, a couple percentage points above that 200-day moving average? Yes, it is. We still got this gap potentially to fill down to the $12 mark. Will we hit that? I don't know. That would be just below the 200-day. It's possible we see a little bit more backing and filling here. Like I mentioned, things stay quiet in the next couple of weeks. However, clearly traders and investors are taking advantage of that huge discount to NAV, very low risk, high reward play. This vehicle tracks the spot price relatively closely, right? This is the deepest discount we've seen this trade at, and we've seen it at a really high premium to NAV. This was back, I believe this was the second week of September. We saw that big premium to NAV. I think it was literally on this day, actually traded up to 1734, closed back down at 1590. But most of the time the trade is close to NAV and therefore tracks a commodity pretty well. So if you're making a safer bet on uranium, you believe the price is going higher, sitting here at $43 a pound. That marginal cost of production that you arguably could have said was 55-ish dollars a pound, maybe a year and a half, 2 years ago. That's likely, considering supply chain constraints, considering inflation, considering the developments that have happened in the past 2 years. I would argue that that marginal cost of production is more like $75 a pound. And so you're looking at close to a double. That's practically a guarantee. So you're not going to see, a 5x return in the Sprott Physical Uranium Trust. Most likely, I'm going to guess anything's possible, right? But that's not something I would bet on. But you will see substantial downside protection. We're not going to see a crash in the price of uranium, back down to $25 a pound. I mean, I can practically bet my life on that. But the upside potential is so much greater than the downside risk reward. So this is a positive thing to see a little bit of a reversal here. Would like to see more volume, but we'll see how the coming days treat this trust. Let's look really briefly at Cameco. Again, not huge volumes. Nice reversal candle, almost touched the 200-day. Denison Mines, another, kind of mid to large cap. Looks like it could potentially be putting in a double bottom here. That would be a positive sign if that holds right about at the 200-day. Overall, the sector catching a little bit of a bid. So I am happy to see that. Nice day for URNM, also almost up 5%. Definitely a bigger day for URNM than URA. Although the volumes are not huge. We saw a bigger volume yesterday than today, but we still have a little bit of trading left to do. Indicators look like they are reversing. That's nice to see. So let's take a look at the mailbag today. Had a question come in yesterday via email from John R. And John states, I saw you tweet yesterday about revised 2022 production numbers for uranium of 135 million pounds and an estimated worldwide consumption of 200 million pounds. This seems like an obvious huge imbalance, yet uranium stocks continue to drop. What am I missing? All right, first for context, I had retweeted something that Quakes posted, John Quakes on Twitter. If you don't follow him, he's a must follow. It's at Quakes99 on Twitter. He tweets primarily about macro developments and kind of news flow, and keeps really on top of the sector on a day-to-day basis, which is fantastic. So he tweeted out that one of the primary nuclear fuel consultants had posted their updated supply and demand expectations for 2022. So they expect the supply to be up 11 million pounds from 2021. That most likely has to do with the fact that Cigar Lake was offline for a few months at the beginning of the year. And we'll probably see a little bit of increased production coming from Uzbeks, maybe a little bit more from BHP, et cetera. But mostly that's coming from the fact that Cigar Lake was offline for a few months this year. Perhaps because Adamprom might come in a little higher next year based on having further well field development this year than last year. They've got that 9 to 12 month lag between when they actually drill wells to when their production peaks. So could see a little bit more out of them, but still not a blowout year when it comes to supply. The demand of 200 million pounds is interesting. So the structural demand of the existing nuclear power plants globally, of what they're literally burning based on their gigawatt production and their consumption of uranium, is about 185 million pounds per year, this year and last year. A little bit up this year. Next year will be up a little bit more, but roughly in that ballpark, right? So the 200 million is taking into account what? It's taking into account the fact that there's been a couple of plants in the States that were slated to come offline that they needed to buy fuel for. That would be the Byron and Dresden plants in Illinois. It's also taking into account that there's a number of reactors that will be starting up next year, and initial fuel loads are anywhere from 2 to 3x annual consumption. And so you have to account for that. New plants will be coming online next year. So there's looking at 200 million in primary demand. and they're looking at 135 million primary supply. Now, what is primary? Primary is actual production. Then you have secondary supply. The main secondary supply that the market actually sees that is actual new supply, and I'll explain that in a second, comes from something called underfeeding. Underfeeding is essentially exactly what it sounds like. It's the enrichers are taking UF6, uranium hexafluoride, they're feeding that into the centrifuges. And what happens is if there is a little bit of excess capacity with the enrichers, what they will do is they will spin down the material in the centrifuge to a lower tails assay. What that means is they will essentially squeeze out more enriched uranium from the same amount of uranium hexafluoride. They'll run a lower tails assay. And so what that means is they literally need to underfeed the centrifuge because they're going to be spinning it to a greater extent to squeeze out more enriched uranium out of that UF6. So essentially, when they make their contract with the utility that's running that fuel through the process, they'll make the contract at a particular tails assay. They then, if they have excess capacity, can spin down to a lower tails assay, and actually they'll end up with extra UF6 on hand, and that's sold back into the spot market, right? So that's underfeeding, and that's the primary source of secondary supply. However, the nuclear fuel consultants, at least the main one, will consider inventory drawdown as secondary supply. And that's a bit of a controversial metric in supply and demand reports, supply demand, how can I say this, studies, models. And the reason is that while inventory drawdown does act as secondary supply, right? If a utility is sitting on some inventory, instead of buying more uranium, they're going to actually utilize some of their inventory. That is acting as secondary supply. However, the fact that they are counting this in their models, they're counting it twice, because that same uranium was counted as supply last year or the year before or 5 years ago. Who knows, right? So the actual supply that's coming in as secondary supply, primarily from this from underfeeding and tails re-enrichment as well. So that's the other part of secondary coming from the re-enricher, is that they have tails that are basically the leftovers from that enrichment process. And again, this is a result of having extra capacity at the enrichment plant. Is they'll actually take that tails material, put it back in the centrifuge, and try to squeeze a little bit more out of it. But the primary is underfeeding. So how much underfeeding is there in tails re-enrichment that's coming from as secondary supply into the market? So the nuclear fuel consultant that I'm speaking of will model out about 25 million pounds a year of secondary supply. And again, that's including inventory drawdown. So the actual amount that's coming from underfeeding and tails re-enrichment is actually more like probably around 15 million pounds. It's been falling because there's been more demand for enrichment, as is reflected in the SWU price, the separative work unit price of enrichment. And so as we see that SWU price rise, we've seen the amount of underfeeding and tails re-enrichment secondary come into the market fall. They've been moving in opposite directions from each other, as would be expected. So this is really a long-winded answer to kind of explain where these numbers are coming from. 2 points I'd like to make before I answer that actual mailbag question, which is like, hey, what gives? This is really obvious. What's going on with the equities? The first part is that 200 million in expected demand coming from the nuclear fuel consultant is not including any secondary demand from financials, Sprott. It's impossible to model that out. As you can see, they purchased 10 million pounds in 4 weeks. Now they've been almost 4 weeks with purchasing very, very little. So it's something that they just can't model. They can't predict investment flows. They can't predict precisely the price of uranium relative to how much money they think that these financial players are going to raise. That's not even including the new ANU Energy, the physical fund that is being established and partially funded by Kazatomprom. It's being established in the East. That's not including this warehouse that the Chinese are stockpiling. There's demand that's coming from non-reactor utility demand, and that's not modeled into this equation. So we're looking at 65 million. Let's include that 15 million of underfeeding just to be accurate. We're looking at 50 million pounds of a demand, of a supply shortfall in 2022, not including financials. Okay. So I want to just line this out for you so you understand what is coming and what is coming down the pike in the coming year. These are the things that we pay attention to. These are the things that we calculate. These are the things that we consider when we're looking at the technical charts in the sector. We're understanding the reasons that things might be selling off and how so far removed they are from the fundamental setup here and the strong likelihood that we'll have a very serious rally, not too far in the future here. So to answer John's question, what gives, what's going on with the equities, why are they selling off? Basically, what are you missing? You're not missing anything. Unlike other industries where there actually would be a supply response, right? You would actually ramp up the mines, work your workers on overtime to take advantage of a rising price environment. The current producers cannot ramp in short order. Okay, you can actually have increased well field development, let's say, is more likely to happen coming from the Uzbeks, by the way, than it is Kazatomprom, and everybody's fearful about Kazatomprom. Kazatomprom is sticking. Their budget for 2022 is set. Okay, so they're not ramping their well field development in 2022, which means increased production in 2023. What does that mean? 2022, 2023 are essentially spoken for Kazatomprom. All right, they're going to still produce that 26,000 tons a year, roughly just under 60 million pounds, if everything goes well. If they don't see further problems with supply chains, which they have already hinted at that they are seeing. So the minimal producers that are producing uranium right now, Cigar Lake, BHP, the Kazakhs, the Uzbeks, Rossing in Namibia, Husab in Namibia. There's a big open pit mine run by the Chinese. These are just not mines that can ramp like that to respond to this supply shock. Supply shock. This stuff takes time. It takes immense amount of capital. It takes massive, complicated underground mines in the case of Canada. It takes huge budget. I mean, Husab mine is a pretty big producer, right? It's being run by the Chinese. They overpaid to get that mine in production to the tune of multiple billions of dollars that they were not expecting to have to pay to get that mine going. It was a major thorn in their side. These things take time. They take immense amount of capital, and so this is why the moves can be so violent in the uranium space, because the supply cannot come online from primary production. Now, I've mentioned before that, is it possible we get to higher 50, 60, 70, $80 a pound and some supply shakes out? Yes, as we've mentioned, that reverse carry trade situation, we have, probably another, 20 million pounds being held in carry that could come into the spot market if we have severe backwardation, which we're likely to have again. It'll come in fits and starts, right? It's not going to likely be a severely backwardated market for an extended period of time. But, some pounds will get shaken out there. Some pounds might get shaken out of Japan when we get up into the 60, 70, $80 range. Some utilities there are responsible for nuclear power plants that have been permanently closed, that are not being restarted, right? So maybe they've got pounds on the books, they want to unload, but they don't want to unload at a loss. They'll wait till the price responds. So we are going to have some supply, some secondary supply come back into the market, pounds that are held in carry, pounds that are held by, Japan utilities potentially. But we're not going to see primary production respond fast enough to fill this supply gap. It's just not going to happen. It's not going to happen in 2022, and it's unlikely to happen to any significant extent in 2023. So ask yourself, what is likely to happen in the next 2 years? What do you think Sprott's going to do? Do you think with a spot market with nobody buying and the price sitting there flat at 43 bucks a pound, you think a spot market with 10 million pounds purchased moving it from 32 to 52 back in August and September, you think that type of spot market is not ripe for investment funds to come in and really set things alight? You got to pay attention to this stuff if you're going to be in this market, especially if you are having a difficulty hanging on or buying when things are red, because the market has just given us an unbelievable gift. And I've never been more bullish on the sector for the reasons I just outlined. So, John, you aren't missing anything. The equities markets often are not in line with the fundamentals, and they will pull back even when the fundamentals are fantastic. And this will continue to happen. It'll happen again. But in between those pullbacks, more than likely, we see strong, very strong runs. And That's what I'm expecting for the coming year. So hopefully that helps. I want to remind Uranium Insider Pro members, tomorrow is our members only webinar. This is the fourth one we've done. We will have CEO and a member of IR as special guests of one of the companies that we very much like, recommend, and own. They will be joining us in the second half of the webinar. The first half, we'll be going through a detailed slideshow of a lot of the fundamentals, and a lot of the stuff that I just discussed will be going in even deeper with some key points that I didn't mention today. And if you are a member, I hope to see you there. If you can't make it to the live webinar, which will be at 11:30 a.m. Eastern time tomorrow, that'll be Thursday, December 16th. If you can't make it live, there will be a recording up later on that evening posted to the website, and you can stream that from the website if you are a member. If you're not a member, you can get a free sample of our newsletter if you click the link in the description. Feel free to reach out if you have questions about our service. We live, eat, and breathe this stuff, and we are very excited about not only the prices that new members over the past month have been able to position into, which is fantastic, and existing members have been able to add to positions, but because of some of the stuff I just lined out and some of these other things that are looking very, very fantastic for the coming year. So cheers. Thank you guys for listening. Hopefully that wasn't too much of a long-winded rant, and really appreciate you all being here. Thank you kindly. There will not be a Uranium Market Minute tomorrow because of the members webinar. So I will see you again on Friday, the 17th. Thank you again. Be well. Until then, cheers.